All right. Okay, so this week's question of the week is,
Oh, yeah.
yes. So what happens if somebody pays their mortgage off early? And are there strategies outside of just one lump sum that people can kind of use periodically to lower their total spend on their mortgage if they kept it for their lifetime?
Mhm. Yeah, so I don't really have slides for that. I
Okay.
do have very nice amortization schedule that I use, and I'll share that with you. I think it's more hands-on and more fun. So when someone buying a house and thinking that maybe they pay early or prepay, first they want to confirm that there's no prepayment penalty.
Right.
And if there is prepayment penalty, how much it is, right? So a regular conventional FHA, VA loans, just traditional mortgage programs, they don't have prepayment penalty. It
Okay.
means that person can pay off at any time, can pay down at any time in any sequence or any type of payments. Maybe every month, extra payments, quarterly, once a year, lump sum, once every 10 years, whatever they want to do.
Okay.
So one thing to remember that if you pay every other week, and you break your payment in half, of course. So let's say payment is $3,000, and every other week you pay $1,500, and that strategy works well for those who receive income bi-weekly.
Yep.
So they can set up automatic withdrawals. With the following week, they know that, let's say that the income is gonna come on Friday. They can set up withdrawals the following Monday, so the payment comes out every other Monday. They will shorten their term by a few years.
Okay.
This way. Why? Because in a year we actually have 2 months with 5 weeks. So the people on biweekly pay, they actually get paid 3 times a month, twice a year. So, and if they're gonna take the pay mortgage 3 times those 2 months, they're gonna end up making that extra payment, extra months of a mortgage payment.
Yeah.
Here. So let me show you actually what it would look like.
Well, that's a good point. So that specifically every 2 weeks, not just twice a month.
Right. Every 2 weeks. That's right. Like
Yeah,
every other
twice
Friday
a
or
month is
something.
once, and first and 15th, it's just twice a month. Every
Right.
Yeah.
Yeah.
2 weeks, it's different. Okay, so can you see well?
Oh, yes, I love these.
Yeah, I can't see anything. My glasses.
Oh, because of the glasses. Okay.
Yeah.
All right. So I blew it up a little bit. Yeah. So these are really fun. I like it. So 600,000 loan amount, let's say, and let's make it 7.125. Just to go with what's average rate right now. 30-year fixed rate. And the payment, that's principal and interest, $4,042.31.
Okay.
So that is 30-year fixed, 30 years. So what happens in 30 years? So you don't really want to see this number. Interest paid over the whole 30 years is $855,233. So what if we make once a year extra annual payment of just PITI, right?
Okay.
I mean, P&I, principal and interest. $4,042.31. Well, watch this here.
Yeah, it knocks off like,
Wow.
what is that?
You see, that's like, I think 5 or 6 years. So let's
Yeah,
go
5 or 6
down here
years,
and see 282. That's 23 years and a half.
So 6.5 years. Yeah.
Yeah, 6.5 years. And remember, we had 855,000 in interest. Now we're down to 634,170.
200.
That's doing one extra principal and interest payment a month?
Year.
A year. I mean, a year.
Right. So, but in reality, if someone sets up the biweekly withdrawals, they'll pay more because the payment, it also includes taxes and insurance, right?
Right.
So the
Yeah.
payment will be higher, but all that is gonna get applied to principal. So let's remove this, and we're gonna say that someone wants to pay how much extra per month?
Let's say $300 a month.
We go down to almost the same, so 659,000, and that's gonna take them 291 months, 24 years and 2 months
Wow.
to pay it off.
That's great.
That's like a lot of people can say, you know what, I'll make my coffee at home.
That's right.
Exactly.
That's incredible.
Yeah, yeah. So just little bits, and it's because of that
Yeah.
compounding effect, because that principal is constantly go down, that lowers the interest that's being paid because it's on less principal. And you just don't realize how effective that is.
Yeah. What
They
if we pay 10,000 a year?
Yeah, do that one.
Play with this all day.
Oh my
We're in the
God.
year 2041 versus 54.
And you're saving $400,000 in interest.
Wow.
Yeah, that's half. 218.
Yeah.
18 years. In 18 years, they will pay it over. So basically, you are amortizing it almost over 15 years.
Yeah.
You can.
So it's almost like getting yourself your,
Mhm.
yeah.
That's amazing. Well, and not only that, but let's say, okay, walk through this with me. Let's say that somebody paid an extra $1,000 a month. And sure, that's gonna knock a lot down over the life of the 30-year loan. But then let's say they're gonna sell in 5 years, they've still almost treated it like a
Or savings
like a
account.
savings account, right? So because they're still gonna have the appreciation when they sell and make all that money back.
Yeah.
Exactly. So let's say, well, let's go with your example. So 1,000 per month extra. Well, let me remove it for a second. I'm sorry. So let's say in 5 years, they're gonna have outstanding balance of 565,500. If they don't pay extra.
Okay,
If they pay extra $1,000 a month, in 5 years, it's gonna go down to 493.
So that's 70,000 difference
Mm-hmm.
over 60
Wow.
months. So that's saving them like 17,000. Is that right? Anyway,
Or let's
that's a lot of money.
do bi-weekly.
Yeah,
Well,
Wow.
that's not because they do it kind of like once a year thing.
right,
Yeah, yeah,
It's
right.
not that big of effect than $1,000 a month, because 4,000 a year, it's not 1,000 a month.
Yeah.
yeah, yeah. That's
That's
really,
crazy. You
that's
don't
great.
realize it would have such an incredible effect.
Yep.
Just doing that little bit.
Mhm.
And these are all things that people can calculate, like when they're looking at their mortgage insurance, when they're looking at how long they want to stay in the property, and and none of this is accounting for appreciation. Do you have any way to add appreciation in there?
Not with this one. However, right here, you can also see what your tax savings are. If you depends on your tax bracket, you can
Yeah.
see actually how much you'll be saving, because interest is tax deductible, right?
Yeah,
So,
yeah.
you end up saving in 5 years, the total tax returned 158,000. I think this is over 47 years, because that's how fast you pay it off.
Right.
Yeah.
Wow.
Wow, that's awesome. All
Mhm.
right. So that's why people need to reach out to you so they can use this spreadsheet to figure out what their best strategy is to pay off their house.
Yeah.
Exactly. I'll be happy to share it. I think it's a great tool to look
Yeah.
at. It's fun too.
It
Yeah,
is fun.
it is.
Yeah.
Yeah. Yeah, you said you'd share it, so send it to us, please. Awesome.
Will do, of course. Yes.
All right. Cool.
Yeah,
Okay.
so
Very good.
that's,
So
That-
first thing is, before you even start looking at any of this, is making sure that your mortgage with that specific lender is not going to be penalized
Right.
for early payoff or any of that.
Mhm.
So, okay.
Yeah,
Very
because
good.
I think what our HELOC, we have we have to have been paying on it for a certain number of years without a prepayment penalty.
Yeah.
So that would be, it's that type of thing that someone would want to look out for.
Yep.
Right?
yeah, and you know, maybe not necessarily if there's prepayment penalty, maybe not necessarily it means that you cannot pay extra. Maybe it means that you just cannot pay it off. Or
Okay,
close it out. So you just need to know the rules of that,
Right.
you know.
That could be really
Fine.
detrimental, because if you're thinking that you, like what's an average penalty? Do you know, like for a lender, is it?
I mean, because we don't have penalties. I don't really know what penalty could be.
Yeah.
We do
Mhm.
have broker out channel is where we do the non-traditional type of financing. For example, when we don't look at the income at all, or we will look at 1099s instead of tax returns, that kind of deal. So we have prepayment penalties in there. And prepayment penalty in our case for those transactions would be 80% of 6 months worth of interest.
okay.
80% of 6 months, really?
months
Okay,
interest.
gotcha. Okay.
Okay, that makes sense.
So it's
Which
not,
is
it's,
not too much either.
yeah, it still
Yeah.
might make sense to pay it off early. It just might be, just got to figure that into your numbers.
Yeah, that's why I say, you need to find out the terms, if there's penalty, and if there is how much. So
Yeah,
and then
yeah.
you do math and think, okay, well, it still makes sense to do it this
Yeah.
way.
Yeah.
And
Okay.
That's the thing, is there aren't hard and fast rules on everything, like avoid this, always do that when it comes to mortgage loans and the finance world. We always say talk to Tatiana, because there's such a big picture with all the different variables that have to be plugged in and considered.
And that's the beauty of this industry, is that it is logical. So like with mortgage for insurance, for example. So I'll talk to buyers and they're like, they will do anything. They will spend an extra 5 years saving to avoid this mortgage insurance. But when you run the numbers with them, and it's like, it's $75 a week or a month. I'm sorry. It's like, you're going to say, it's not, it's not worth going through all this to save up an
Yeah.
extra $20,000, $30,000 just to avoid $75 a month.
and lose 200,000 in appreciation,
Yeah,
right?
exactly. So it's like,
My grandpa always said, never pay a mortgage.
that's you cannot pay it. It's a ripoff. So
It's
that's
not
what.
that bad these days. It
Yeah.
just has a bad name.
Yeah.
Yeah,
Right.
absolutely. Okay. Well, thank you for that. That was really interesting, and I really look forward to that spreadsheet. I'm gonna play with that.
You will. Thank you, and I hope you have a really great Memorial weekend.
Yep.
You too, guys.
All
I'll
right.
see you
I'll see you next week.
Bye.
Bye.